Welcome to the Learn to Win Trading Day Trading Crash course. This is video 1. We're going to be talking about technical analysis and probabilities in day trading. First of all, there are two different types of analysis for trading. Number one, there's fundamental analysis, and that uses a lot of data on corporate news, management, economic reports, news reports, releases. It's a very time-consuming type of analysis because what you're doing is you're taking all the different types of components that affect the price of a stock or the price in the market, and you're trying to identify undervalued or overvalued prices to determine future price movements. It can be a very complex type of analysis and sometimes very time consuming because you're trying to identify all of the different variables that will affect that price. Then there's technical analysis, and that's the analysis that we use with our day trading system. Technical analysis is a visual type of analysis. It's not the number crunching that fundamental analysis is, but it's a visual type of analysis using charts to identify patterns and indicators in those charts to identify the strength behind those patterns. And what we're doing is we're using past market movement to then predict future market movement. Technical analysis actually allows you to look at a chart and very quickly be able to identify the statistics behind repetitive patterns, quickly identify your entry signals, and then execute your trading decisions. It's a very efficient way to trade, but then again, there are different types of strategies and different ways to analyze the market that just fit different types of people's personalities and goals. So this type of trading is not necessarily for everyone, but it's a more visual type of trading, and that works for me, and I tend to associate things much better more visually. There are probabilities in trading, and this is the thing that really goes to work for you when you use technical analysis in trading. It's the real fundamental theory behind using technical analysis. What you're doing is you're making probabilities work for you. Type of analogy, let's take a vacation to Las Vegas, for example. The industry with casinos is incredible. What they are able to do in building a business around a game based on pure chance. Now what they do, they understand something about probabilities, a lot of probabilities that most people don't. Let's show you, for example, the game of blackjack. The game of blackjack, completely random results for the most part. You know, with the deck of cards that you've got, every hand is independent and random from the other hands. But what they do is they've built rules around the game of blackjack that actually give the house a 4.5 cent edge on every dollar that crosses the table in a casino. So then what happens is no matter what they win and what they lose over the long run, the house will always come out on top. It's a matter of macro level versus micro level. In the micro level, every hand is unpredictable and independent. But on the macro level, with a large enough sample size, what you're going to find is that the house wins more than they lose, and that's how they come out profitable. Let's just say, for example, that $100 million crossed all the blackjack tables in a particular casino in the course of a year. Well, at the end of the year, that casino is roughly going to profit $4.5 million based on the rules that they have and the edge they have in the game. Now this can actually work for you in the market if you can use a strategy or a system to help you identify a pattern, a particular pattern that tends to repeat itself in the market. For example, like one we teach is a stair-step pattern. And then what you're doing with that pattern is then combining it with lower indicators or some sort of indicators that will show you the strength behind that pattern to give you more probabilities in that pattern actually running your way. And then what we do is we've got some other indicators, some lines up top that actually then help us identify our entry points. So what we're doing then is we're combining several different factors here to produce one complete high probability trade. And what that does then is allows us to trade each signal, on the micro level, may be completely random and independent of itself, but over the course of a long run and with a large enough sample size, our signals are going to win more than they lose. Systems work and people fail, and that's really the key to this whole thing. People fail because we're programmed to make decisions based on emotions. But when you have a system set in place, which provides a set of rules for you, what you're going to do is you're going to find that the rules will then direct your decisions instead of being based off emotion. Your indicators are going to confirm the patterns that you're seeing. It's going to create an edge for you in the market, producing high probability trades. No strategy is 100%, but all strategies are designed to put the probabilities in your favor. And if you can then figure out how to trade that strategy consistently, following the rules with complete ironclad discipline, then what you're going to do is let the strategy and the probabilities go to work for you instead of making decisions based off of emotion. There are hundreds of different types of strategies out there, and the real key is to find a strategy that fits your goals and your personality, because if you don't find that, then you're never going to be able to develop the confidence you need in a particular strategy, and the confidence you need in yourself and your own discipline to follow that strategy to really be successful. So why is it with all those strategies out there that 98% of day traders actually fail or lose money? Well, the answer is quite interesting, and it's a very critical key in day trading. We'll talk about that in video 2 of our series, where we'll be discussing the psychology of day trading and how futures work.